So, welcome everybody. This is the Professor's Take with Professor Nick Bollen. A couple housekeeping items. We're going to mute everybody to avoid random distractions like dogs barking, and then everybody can unmute for Q&A at the end. And then if you have questions during the talk, use the chat feature. Otherwise, just wait for the Q&A at the end, and then you can unmute and do it then. A little background on Professor Bollen. He graduated with a physics degree from Cornell, got an MBA from Duke University, as well as a PhD in finance from Duke. He is the Frank K. Houston Professor of Finance at Vanderbilt, as well as the faculty director for the MSF program, where he teaches financial economics and is beloved by many. He's published over 20 papers during his time at Owen, and he's Owen's very own hedge fund expert, in addition to many other things. And so without further ado, we'll leave it to you, Professor Bollen. Take it away.
Okay, thank you, Michael, and welcome everybody. First, I'd like to congratulate all of the graduates. Well done and good work. And second, my thoughts are go out to all of you who have had your careers or internships delayed or otherwise interrupted. You're facing a once-in-a-lifetime challenge, but you can take comfort in knowing that markets are forward-looking, and they all already reflect, a robust post-COVID-19 world. In addition, as I'll mention at the end of my talk, any crisis like the one we are currently living in presents opportunities. And those of you who have studied finance or strategy are especially well positioned to benefit from them. So today what I want to do is put the coronavirus and its impact on markets in a historical context. And my theme is that in financial economics, we often make a distinction between risk and uncertainty. Now, to see what I mean, what I want to do is compare and contrast the current episode to two other stock market crashes. So the crash of October '87, in one day, the S&P 500 dropped over 20%. Now, while there was no clear trigger in terms of the macro economy, those that have studied this episode tend to lay the blame on program trading, perhaps one of the first episodes caused by program trading. And what happened at the time is there was a strategy called portfolio insurance that a lot of portfolio managers were using. And it was a simple algorithm that the purpose was to simulate or mimic the protection that put options have. So the way it would work is if the market starts to drop, a sell order was automatically created. Well, of course, if a lot of people are doing that, the sell orders push the markets down further, and there's kind of a cascade effect. Now, the other two episodes have completely different causes. The financial crisis of 2008, 2009, in which we saw a total drawdown of the S&P 500 of over 50%, was caused by excessive leverage, both at the individual level in the form of real estate finance, but also at the institutional level as investment banks and other intermediaries were using relatively new derivatives to increase their debt capacity. The consequence really was a fundamental breakdown in our financial system, which took a number of years to remedy. And then, of course, the current coronavirus, we see the S&P 500 dropping over 30% in March. The reason is clear. The governments around the world put their economies in a shutdown mode in order to spread or halt the spread of the pandemic. So to kind of compare these quantitatively, a simple thing to do is simply to plot the S&P 500 price levels. And what I've done for all three is index them to 100 so we can compare them about 3 months prior to each of the crashes. So over a 56-day trading period from the beginning of 2020 to sometime in late March, we see all three episodes resulted in about a 30% drop. The black shape that you can see here is the October 87 crash, and that happened a lot sooner or faster than the others because of that 20% drop in one day. But at least in the short term, the three look comparable in terms of their severity. Now, what's interesting is if you extend this to like this past Friday, now we see a significant divergence. The blue shape there is 2020. And what you can see is, unlike the other two episodes, we've had a dramatic rebound. So more than half of the loss has been recovered just in a matter of weeks. In contrast, the other two kind of bounced around for this period. So this rebound caught me and probably most people by surprise. The trillion-dollar question, of course, is whether it's a rational response to expectations of an economic rebound and eventually a virus, or is there some other cause for this dramatic recovery? So we'll get to that in a little bit. Well, let's take a step back. Here's 2 years prior to each episode, and we start to see some differences. So in black, that's the 87 crash, and you can see that occurred after a 2-year run-up of over 70%. Similarly, in blue is 2020, and that also occurred after a very good year in 2019. So those two are similar in the sense that there is this really sharp turnaround from a very bullish sentiment to that shock. Now, the 2008-2009 drop was preceded by a fairly long period of gradual declines as cracks in the financial system gradually appeared and widened. Now, you can also see in this graph again the big rebound over the past month, and that's certainly different from what we saw in the other two crashes. Now, everybody wants to know what's going to happen next, and of course that's what we always want to know in investing. Well, what we can do is look at the 87 and 2008 period and look at what happened over the next 2 years. Now, again, in black is the 87 crash, and you can see that after people got over that initial shock of the 20% drop, the prior kind of sentiment returned, and within about a year, the loss was fully recovered, and markets kind of continued upward. In red is 2008, 2009, and there you see markets kept dropping for another 6 months or so, and then only gradually began to recover as the Fed developed a new set of tools for fixing the economy. So what to say about 2020? The market has regained most of its loss. The only way you can justify that is the expectation that a virus or a vaccine will be created by the end of the year or early 2021, and there'll be no lasting kind of economic damage. Now, it also reflects dramatic and unprecedented support by the Federal Reserve and the Treasury, tools which were developed over a period of years after the 2008-2009 episode. So this time is somewhat different in that those tools had never really been laid out and used so widely and so quickly. Now, all that said, there's still a great deal of uncertainty in how fast and how well the virus will be contained, and perhaps we'll get some insight tomorrow when Larry Van Horn speaks. Given that uncertainty, it's surprising to me how quickly the loss has been recovered. And I do expect at some point a bit of a retreat, but I've been saying that for a number of weeks and have been wrong so far. So that's about all I can do in terms of forecasting. All right. So one way that we think about forecasting is, of course, doing some fundamental analysis. And what Craig Lewis mentioned last week is that people often use a PE ratio to get a back of the envelope sense for how richly valued stocks currently are. Now, what I'm plotting here is the Shiller PE. This is the S&P 500 price level divided by a 10-year moving average of aggregate earnings, and it's inflation adjusted. So the way to think about this is how many dollars you're paying per dollar of current earnings. Now, going back to 1900, the long-term average is 17. And what I'm going to do now is drop in the three crashes with some sound effects, because my students know I'm a sucker for corny PowerPoint tricks. And what you can see is some differences here. So the first two, in 87 and 2008, you'll notice that after those crashes, the PE ratio was below the long-term average. So at that point, there was some room to run, and it sort of supported a recovery. And what is, to me, something I just can't get over is that even after, the crash that we've experienced in 2020 and recovered from largely, we are still like way above the long-term average. So that suggests to me, there's limited upside from where we are right now. The only times we've been higher were in the late 20s, late 1920s prior to the Great Depression, and then in the late 1990s prior to the dot-com bubble bursting. So, so this to me, like I said, is a bit of a resistance level to further recovery. But maybe, maybe this time is different. One thing you can see from this graph is if you go back, say, to the early 80s, we've been on a long-term sort of upward trajectory. Are there reasons to explain this and justify staying above the long-term average for the foreseeable future? Well, there are. So to say that market is fairly valued right now, we have to think about macro reasons why the economy and markets are different than they used to be. As I mentioned, we have experienced unprecedented support from the Federal Reserve. So people say, don't fight the Fed because they'll do whatever it takes to support the economy and the market as sort of a byproduct. And to me, this is a little troubling. We are talking about, trillions of dollars of support in waves. As I say in class, we used to never really use the word trillion, but we do it now at the drop of a hat. And, to me, I start to worry with these continued waves of support, because what we're really doing is borrowing from the future to help ourselves now. And at some point, I worry about, my children and grandchildren and the bills that they're going to have to pay. Part of the Federal Reserve's actions are, of course, to depress interest rates. And actually, since the early 80s, we've had a long-term decline in bond yields. And especially with the actions of the Fed, we get this term called TINA. There is no alternative to investing in the stock market because bond yields are so low. Now, TINA can be thought of as a search for yield. So if you can't earn anything in bonds, then you're going to look for higher returns elsewhere, even at the expense of higher risk. But you can also think about a fundamental impact of sort of lower interest rates in the future, and you think about that in terms of a dividend discount model. So here's a formula, a PE ratio. And in the numerator, I'm replacing price by the present value of perpetuity with growth. So D for dividends, R is the discount rate, and G is the growth rate in dividends. Well, where do dividends come from? They are a percentage of earnings. So I'm replacing dividend D by earnings times payout. And you can see the earnings cancel. And what we're left here is a term in the numerator is the payout rate, and in the denominator is the discount rate minus the growth rate. Now, if interest rates are going to stay low for the foreseeable future, that will lower our required rate of return. So that would raise sort of the equilibrium PE ratio and justify why we might stay above the long-term average for the foreseeable future. But on the other hand, if you think about growth rates and how they are related to equilibrium interest rates, we tend to think about interest rates being low when growth rates are low. And the idea there is if we're in a low growth environment, the opportunity cost of investing in a bond is lower, and so you accept a lower yield. So we might expect both lower discount rates and lower growth, which sort of the effect kind of cancels out. So I'm still sort of left deep down in my finance professor's bones thinking that the market is richly valued right now. And of course, I could be wrong. We saw a bubble in the late 90s where PE ratio shot up to 30 and 40, and maybe we're going to see a repeat of that with the importance of the tech sector. But that's about all I can say in terms of sort of where we are right now in the stock market. So what I like to do is take a bit of a step back and think about these crises a little bit more conceptually. And here kind of return to this distinction between risk and uncertainty. Now, when we talk about risk, we typically think about variation from the norm or the average value. So on the left, you see an urn with a normal distribution. And, in normal times, maybe we expect stock returns to be distributed normally. And if we pull out a return for a given year, maybe it's 8% for that year, right? So that happens year after year after year. And then all of a sudden, something out of the blue happens and the entire distribution changes. So this is more like uncertainty, where the structure of what we're used to is fundamentally altered. So maybe now the distribution changes to one that is more heavily weighted to bad returns, like this beta distribution. And so maybe there we get a big negative return that we wouldn't otherwise expect to see. So one way we can think about the three crashes is a shift in the data generating process, where it fundamentally alters for one reason or another. All right. Now, different authors have described this sort of uncertainty in different ways. So former Secretary of Defense Donald Rumsfeld, he labeled these unforeseen occurrences as unknown unknowns. The idea being we didn't even anticipate them, right? Things that you weren't even on your radar screen, like terrorists flying into the World Trade Center. Nassim Taleb, he's a former option trader and risk manager. He wrote a book called The Black Swan in 2007, actually foreshadowing the crash of 2008, 2009. And this concept of black swan is that, centuries ago, Europeans thought swans were white. And it was only until they explored Australia and saw a black swan that was, something that they had never even anticipated. And actually, those are quite common in Australia. And then finally, just this spring, two English economists wrote a book called Radical Uncertainty, which is their term for outcomes that are outside the structure of a model. So that if you build or calibrate a model in the normal world, that model will fail sort of catastrophically when one of these shifts occur. So it's amazing timing on their part. And it's a really interesting book. I encourage all of you to read it. Now, following along their reasoning, King, we're left with sort of a dilemma. So what do we do if our models are prone to fail because of uncertainty? How do we sort of expand the nature of our models? And there's actually ways we can do that. So there are different statistical models that allow for a shift in distribution. Two examples. A regime switching model actually specifies two distributions or data generating processes. So for example, we might have a normal distribution that governs, say, returns with some probability omega. With probability 1 minus omega, returns instead are drawn from some other distribution, maybe one that's really negatively skewed. I studied regime switching models in my dissertation as a PhD student and their impact on option prices. And for those of you that have studied option valuation, if in normal times, there's still a chance that the distribution will shift, well, the option is going to be much more valuable because there's a chance that the volatility is going to increase. So regime switching models are one way to incorporate a switch in the distribution. Another is what's called a jump model, also used in option pricing, where you have a diffusion component that's like the normal return, and then a rare jump that maybe occurs once every 10 years, where the price level is shifted. So that's another approach. Now, my main issue, or the main issue with these complex models, is they still require the user to calibrate to specify the underlying parameters. And if these underlying parameters are related to these rare events, well, it's going to be very difficult to do so. The other criticism is that we can always write down a more complex statistical model to fit what we observe. But what about things that we haven't observed yet? So we don't really gain any qualitative insight from abstract theoretical models by themselves. So I see a question here on the chat. Question is, how correlated is the market with economic prosperity overall? Can the prior crashes inform what we might see on any of these dimensions? So that's from Mark Cohen. Yeah, that's a good point. Another perhaps difference between our current environment and 20 or 30 years ago is the extent to which the stock market reflects the economy more broadly. There's a good article in the New York Times about this over the weekend. There seems to be this massive disconnect between the economy sort of as a whole and the stock market, because there's certainly not a lot of good signals out there about economic activity right now. So some of the arguments for why things are different now is that, well, if you look at the concentration of market cap, it's sort of unprecedented, I think. Top 5 companies in terms of market cap, all tech stocks, constitute about 20% of total market cap. So clearly, the market is being driven by a small subset of businesses. Furthermore, there are hundreds of thousands of small companies that are not public, and so the stock market does not reflect what's going on there. There's been a decline in the number of publicly traded companies over the past decade or so. So again, you start to see maybe there is this distinction we need to make, and that affects how we think about investing. We have to sort of separate the news we're getting on CNN or wherever about the economy and the world at large versus what we think the stock market might do. Correlations have been going down. Another question about Monte Carlo simulation, and actually let's think about other ways we can reflect the possibility of a rare event. One thing I do in class is introduce rare events in a simulation, and actually that's a bit like the jump model that I talked about, where you have normal returns most of the time, and then you also draw from a discrete distribution whether or not a jump occurred, and that sort of overlays or replaces the normal return. So the Monte Carlo simulations that we do in class are actually ways of implementing or representing the the jump model that I talked about. But other ways of thinking about uncertainty, scenario analysis. So if you're thinking about a business plan, for example, rather than worry about a statistical fit, lay out future economic conditions or situations. Maybe we have a normal business cycle, perhaps a banking crisis, a war, a pandemic, a contraction, and try to make your business model a bit more robust to those sorts of uncertainties. At least think about how that might be done, and maybe it's saving for a rainy day, diversifying a supply chain, things like that. Actually, Nassim Taleb, his follow-up to the Black Swan was about making your model, be it a security evaluation model or a business plan, more robust to these sorts of uncertainties. And then finally, real options that most of you have probably seen in class at one point in time at Owen. This is a way of thinking about managerial decisions that could be made in the future in response to shocks and these rare events, and that allows one to incorporate the impact on future cash flows as managers respond to these events. So those are some approaches to think about. In terms of portfolio management, how might we deal with uncertainty? And I would posit there's at least two main approaches. One is portfolio insurance. As I described earlier, a simple version of this was adopted in the 80s, and actually, like I said, is sometimes blamed for the crash in '87. A more modern version are tail risk hedge funds, which are like insurance. So the way that they work is they invest in things like out of the money put options, maybe safe haven assets like gold and other strategies. And these tail risk hedge funds, they tend to lose a little bit of money most of the time. Doesn't sound like a good idea, right? Like a good deal. However, what they do is these securities and strategies, they pay off hugely when markets crash. So if you are, say, a pension fund manager, having a small allocation to a tail risk hedge fund is a way of buying insurance against this kind of uncertainty. And in fact, Nassim Taleb, he is advisor to one of these tail risk hedge funds called Universa. And I saw this headline back in April. That fund earned apparently 3,600% in March, and that's why you invest. That's why you would invest in a tail risk hedge fund. So for the investor, this is kind of like a passive way of dealing with regime risk, an allocation to one of these tail risk funds. And then a second way is to try to react faster to changes in economic conditions. So I saw a webinar on Friday by a professor at Cornell, who's also a professional fund manager and advisor. And he talked about nowcasting as opposed to forecasting. And the idea there is, especially in this world of big data, managers have the ability to observe in real time things that in the past were only observable with a long delay, like inflation. So he presented this example, this chart, and what it shows is that some commodities like copper start to drop in value way before the stock market did, as a result of industrial production in China dropping substantially as that economy was shut down early. All right. So his argument is that big data presents this opportunity for managers to react faster to changes in regimes. Now, the issue I have with this approach is the cost of being wrong. This is a very active approach, and you might have a lot of false positives, in which case you're going to switch your portfolio, you're going to switch your strategy sort of at the wrong time. So there's going to be a lot of trading costs and potentially missed opportunities. Now, Professor DePrado, he made it look easy because we all know that the COVID-19 event occurred, and we can go back and look for sort of confirmation of this. But I will agree that his basic message is sound, and that is that big data is changing the way active managers can respond to crises, and perhaps that explains the rapid moves in the market that we saw both on the way down and on the way up. Guess I'll conclude by talking briefly about the opportunities that all shocks create. Now, definitely they're unsettling. You students, especially, you had to deal with this abrupt move to remote education, an uncertain economy that you're heading into. But shocks also, create opportunities for those who can adapt and exploit them or profit from them. And I would argue that those with graduate management degrees are especially well positioned to do so. You think about all the restructurings that are going to occur, changes in strategy, mergers and acquisitions. I see all of that activity being at high demand over the next few years. And from an asset management perspective, we're going to have to change the way we think about equity valuation, at least for the foreseeable future, to accommodate changes that we expect. And certainly, I've seen those commercials from TD Ameritrade way too much lately with that guy in the beard in the green room giving advice to, to individuals. There's the reason being, people are going to be thirsting for investment advice. And that always occurs after a crash like this. So those are, my prepared remarks. So thanks for listening, and be happy now to try to address any questions that you might have. And if you come up with one afterwards, feel free to shoot me an email, and I'll try to respond. So yeah, why don't I unmute everybody? Or actually, I'll let you unmute yourselves. I think you can, and or you can go to the chat room to ask me any questions that you might have.
Hey, Professor Bollen, thank you for speaking with us. I have a quick question regarding the Black Swan funds. So when I took Professor Whaley, he referred to inverse leveraged ETFs as non-buy and hold assets because they were so volatile that if you held them, eventually you'd basically go bankrupt with them. How does that parallel to like a Black Swan fund that you're kind of waiting for that cash flow and it's random in a 10, 15-year horizon?
Well, that's a great question. You might think about investing a small amount of your wealth in an inverse ETF as a way of gaining that insurance. So if the market drops, these inverse ETFs will take off. However, they're one specific vehicle, and the way that they're structured, as Professor Whaley has researched, make them unsuitable for anything other than very short-term bets. So this rollover strategy that they employ with futures contracts guarantees that they will lose a significant amount of money over the period of a year. So the tail risk funds, they're different than that. So they're structured differently. They typically will lose maybe 5% per year, as opposed to the 90% per year that you might lose in an inverse ETF. They invest in different things. So it's not that they are just short the market. They'll buy some out of the money put options, which don't cost much. They might expire worthless most of the time, but they only do that, with some of their money. They'll invest in gold. They'll have a whole bunch of other strategies at play. and they're, like I said, more like homeowners insurance, where you pay some percentage of your home's value every year, and most of the time you lose all that money. But when the when the market crashes, it's like your house burning down. That's where the insurance really pays off. So so they're structured differently from the inverse ETFs, and they don't lose money as dramatically fast as the inverse ETFs do. For that reason, they would be more suitable for sort of a long-term insurance play.
And would those out of the money options, would they be like a 10-year dated option or something like that? Or would they just do like a 1 year and roll it over as it expires?
Well, it's going to be very difficult to find liquidity in those longer term options. So, part of the reason that these managers can justify high fees is they're going to be smart in how they do this. And it might be a combination of things, including buying, really cheap, deep out of the money options that maybe expire in 3 to 6 months, continually roll those over, as well as maybe they could lock in a longer term, swap deal or something else that would provide that kind of protection.
Gotcha. So some type of laddering mechanism.
Yeah. So not just one, simple strategy, and one that responds itself to market conditions.
Understood. Thanks so much.
Sure. Let's see. There's a question on the chat room here. As the supply of treasuries continues to increase, do you think there will be a point in the medium term when the market, except the Fed, will not be ready to absorb that supply and create distress in the debt market? How do we forecast that possibility? So for better or for worse, the United States is in a unique position globally as being like the reserve currency, right, or having the reserve currency. So I think we're widely viewed as the deepest, safest pool of bonds, right? Those issued by the U.S. Treasury. One thing I've done in class and continue to look at is the performance of U.S. markets over the past 30 years relative to markets around the world in the context of like a global allocation problem. And it turns out that 100% U.S. has been like the way to go for a long time. So I guess what I'm trying to say is for the U.S., I don't see an end to the thirst for our treasuries. And I say for better or for worse. I mean, for the better, that means we can fund sort of incredible stimulus efforts. But the downside is it's like too easy to do. And that imposes a burden on future generations. And at some point you have to worry about our debt bearing capacity, especially if and when interest rates return anywhere near their long-term averages. Let's see what else. So Philippe has a question about the Fed buying ETFs. And I think there he might be referring to like the corporate bond ETFs. Who is it buying from? Is it relying on authorized participants to buy the underlying assets to provide liquidity to the companies it's trying to help? And yeah, I'm not an expert in ETFs, but the for them it's a vehicle for actually being the claimant, the owner of the underlying corporate bonds. So yeah, as demand for the ETFs is created, authorized participants create them by buying the individual bonds and packaging them, and that sort of backstops or is what you own through the shares of the ETF. That's my understanding.
Using it for time since the Google was. Oy.
I unmuted everybody just in case, people were having trouble doing so. So now I'm starting to hear
I do
the
too.
background. And,
Hey Google, what time is it?
I think I'll go back to muting everybody. There you go. Phew, made it. Yes, I'm getting used to leading Zoom sessions. So, here we go. Got some action. Is there a reason why the Fed during this phase of easing bought more treasuries than mortgage-backed securities? Generally, during quantitative easings, they have bought more mortgage-backed securities in the past. Any particular reason for this? Well, all I'm doing here is repeating what I heard on Squawk Box maybe a month ago or so. But the Treasury market was itself under stress. And I don't really understand why. But clearly, the Treasury market is the first thing. If you see problems there, that needs to be addressed first. Mortgage-backed securities, so they play a different role now in markets than they did, back in 2007, 2008. Their lending standards, have been strengthened substantially. We don't have as much junk as we did back then. So it's it's because, like I said, there were distortions in the Treasury market itself, is why the Fed jumped there first to make sure that market was operating properly. Okay, well, don't see any more questions, so I think I will. Thanks again, you, for your attention, and feel free to contact me if anything comes up. All the best. Take care.
I think we got one last question in the chat.
Okay. Do you have any comments about whether the U.S. is heading towards economic inflation or deflation? If anything, I would say the risk would be deflation. And that's related to my comments earlier about sort of a global thirst for U.S. Treasuries. So I do not see a risk of inflation when you see long-term interest rates close to zero and commodity prices dropping, where you have uncertainty widespread. That's where you worry about deflation. And that's what I would be more concerned about. But, something that's different about this crisis than, say, 2008, 2009 is we know why it's occurred. And once there's a vaccine, it'll largely, I think, be addressed. And there will be no sort of fundamental long-term break on economic activity. So I wanted to kind of end with that positive note. So I do see, it's going to take time to recover, but because we know the culprit, once the vaccine is out there, I anticipate a fairly robust and full recovery. And I don't have anything to say about the influenza pandemic of 1957, but maybe you could ask Larry tomorrow, more of a health expert than me. So, all right, take care, everybody.
Thank you, Professor Bollen.
You're welcome.